there's a lot happening right now.
Which is good and bad. I think sometimes people think that it's controlled by the bank or
That's
by
right.
the mortgage company.
That's right.
It's
That's
not,
correct.
actually.
So, but the most people that I've been refinancing have been crazy over the last couple of weeks, trying to get everyone in and getting everyone locked into a rate. And to get the appraisers out to these properties. The appraisal business now has been decimated. Most of them have left in the last couple of years, and now we need them again. So the appraisers have been very busy. But refinancing, just in general, I mean, it's terrific right now. If you have the equity and you have income enough to prove, to show that you can qualify for a mortgage, it's a great time. It's a great time to refinance and a great time to buy. We're hoping that these low rates and the prices being down, I think it's a great opportunity right now for a first-time buyer that's renting here in Somerville that may want to go out and buy a place.
I totally agree. I think it's well primed, especially for first-time home buyers, to take advantage of, there's opportunity for everybody. Right, in these different markets. It's just, which side are you on and what are you able to see? And so it's getting to, so for first-time home buyers, they get the benefit of the depressed housing prices and they get the benefit of the lower rates. And so two things that I want to make sure we cover before we finish the show. One is on this refinance topic, what can affect someone's rate, like why your rate might be different than your rate. And then the second thing on refinancing is, let's cover that first one and then I'll get the second one.
I think on the issue of rates, and not so much, why is a Winter Hill Bank rate different than a Fairway Independent Mortgage rate, but why is Belinda's rate different than Joe Smith's rate? And what has happened over the past several months is that they have started to put in rate pricing based on your equity position and your credit score. There are some other minor factors, but those are really the two that are most important for people to understand. A credit score of 720 or greater gets the best interest rate. Under 720, even if it's a 719, which is a perfectly good credit score, has a rate adjustment upward, right? So it's very important that a consumer know what their credit score is, and there are various ways to access that, but the mortgage score is the most important one that you get and from your mortgage lender. So before you start to consider buying or refinancing, you can go through a pre-approval process where we can advise you as to what your credit score is by reviewing your credit report with you. The other piece
and you would recommend that people go through that pre-approval process, I assume. Absolutely.
And the other piece of that is if you have 40% equity in your property, which let's face it, most people do not, versus 20% equity in your property, there is also a rate differential for that. So when you're sitting at dinner with your friend and your friend says, I just got a great 5% rate, and you call me up and you say, hey Amy, my friend just got a 5% rate, and I look at your credit score and we talk about the value of your home, I might have to inform you that you're going to get a 5.25% rate or a 5.5% because perhaps your credit wasn't as good as your friend's or your equity position wasn't. And people are very accustomed to saying 30-year rates, they're 5%, but they are consumer specific now,
and
property and consumer specific.
From 0.25% to probably
to 0.75% difference depending upon credit scores. And what people are starting to consider again, Belinda, and again historically, like where we paid closing costs, most people have not paid points in a very long time. But because of the rate differential, you can choose to pay a point. Let's just say, for argument's sake, that the difference in fee to a lender between a 20% equity position and a 40% is 1 point, and that might be 0.5% higher in rate for you. You could choose to take the 0.5% lower rate and pay the 1 point fee. So
that's
that
part
you
of the
have
cost
options.
benefit that we spoke about. That it's so important to
you
do.
have the option to get the same rate as your friend, but you may have to pay a fee in order to do that.
Great.
So there are options available that you should inquire about if you're told that you have to have a higher rate.
Okay, that's a very helpful point. The part two that I was going to say is we touched on the adjustable rate mortgages, and we're going to start to wrap it up. It's amazing how fast the show can fly by when it's such an interesting topic. So we mentioned that people may have adjustable rate mortgages that may have very low rates right now, and yet I often still encourage people to fix in to one of the low 15-year, say, or 30-year rates now because we do expect that rates are going up. Do you have anything that you want to touch on about that point at all? Do you have any recommendations?
Well, I would too. I think it's a good idea. Oh,
recommend that people fix in?
Sure.
Because it's misleading when people say, but my payment's going up because I'm at 4%. Even if I lock in, I'm locking in at 5%. Why do I want a higher monthly rate? Right. But I think it's very important for people to think also, not just today, this month, but on a longer term basis. Let me lock in for the next 15, 30 years at this lower rate.
Very dependent upon your objectives, how long you think you'll have that mortgage. There were a lot of people who were coming up for adjustment last year prior to all the speculation about rates going down, who we advised to let their rates adjust because they were going to adjust so incrementally
and down
and then that now they've been able to take advantage of the lower rates. But that's sort of a crystal ball attitude, and so you have to be very careful with that and look at somebody's overall financial package.
Right, I definitely appreciate that. And
right. And one of the we actually do have one product that doesn't have any changes with FICO scores and the type of property the way that Fannie Mae does. It's called the My Community Loan through Mass Housing, which anyone that's eligible for that right now that has like a multifamily right now, I have to add 1 point for a 3-family.
How about a 2-family? I have one of those.
Well, right now we're at a half, but as of 1 April, Fannie Mae is adding on 1 point.
Wow.
So if I have a single family and I lock, or another person is at 5%, you're at 5% with 1 point. And if I try to factor that rate in there, you're looking at 5.375. Well, there's particular product through Mass Housing that we're eligible for, that we do. I do a lot of loans with them through Mass Housing. They don't have that bump to the rate. So, but there's also income restrictions with that, and there's different twists to that loan too. But it is a 30-year fixed, and the rate's very competitive.
There are a lot of programs, like the My Community program that we offer as well, and the FHA product is becoming very popular again, which is the Federal Housing Administration program. They only require 3.5% down on a purchase, and they have no adjustments for declining markets. So whereas Fannie Mae, if you're in a declining market, you may be forced to put more money down. Under a My Community program or an FHA program, you are able to put down as little as 3.5%.
Great. Well, thank you. Thank you both. Do you have any last closing thoughts? And one of the key things that I've learned from this too is really the importance of having a relationship with a mortgage broker, mortgage planner that you really appreciate. So, and can relate to and can talk to, who can help you with this cost benefit analysis, understanding all of the terminology and how what's happening right now affects you.
I think that's a critical point, and I would say to anybody, stay away from the internet as far as getting a mortgage these days, because you do need a one-on-one relationship, and it isn't just have a pulse, get a loan. It's very, very detailed, and you really do need to have somebody analyze that for you.
The mortgage business is more complex now than it ever was.
Right.
And the changes every day. Fannie Mae is putting out different addendums to their guidelines, and I spend hours just going over them, making sure that I understand every change.
Right.
Wow.
Because each and every change could affect depending on what you're doing.
Right. So that's why we need you on our team.
Absolutely. Nothing is static in the mortgage industry right now.
Absolutely.
Stay away from the internet when you look at mortgages. Are much too complicated for that right now. You need to talk to someone that knows what they're doing.
Absolutely. There we go. Well, thank you. That's a great way to conclude, actually, our show. And so today's topic was on making sense of the mortgage industry. And so you can stay tuned for more strategies, tools, tips on what you can be doing to save, to plan for retirement, to manage your debt, manage your credit cards, and so much more. You'll learn tips that you can use immediately. If you have any feedback for us, any questions, any ideas about saving and the money on your mind, contact us at moneytv@ownyourmoney.com. Thank you for joining us today. My name is Belinda Fuchs. I am the host of Money on Your Mind, a CPA, wealth coach, and president of ownyourmoney.com. Join us again to learn more ways that you can make more, save more, and stress less about the money on your mind. Thank you.
Messing around with jerks. My car is parked outside. I'm afraid it doesn't work.